So this is all about the chapter. We'll just go to the question that we have left, this one. So this will cover all the concepts of this chapter. So this is a very good question. Maybe next 15 minutes we'll spend here and solve it one by one. All the points. Pepper Company is contemplating 3 available investment opportunities. The cash flows of which are given below. Initial investment, that is year 0. Okay. 125 in project E. In project F, 120. In project G, it is 170. Year 1 cash flow is 50. Year 2 50. Year 3 50. Year 4 50. Then for project F, the cash flow is 15, 15, 15, 15 and 200. Then for project B, it is 120, 80. Okay, only 2 years cash flow. In each case, the initial investment represents the purchase of a plant and equipment whose realizable value will be 20% of the initial cost. So it is giving an indication of scrap value. Year end will get some scrap value also for all these 3 projects, which is to be added to the cash flow. And also, while calculating the annual rate of return, we have to deduct it. In addition to the above flow at the end of the life of the project. So year 5 or the last year, we have to add 20% of the initial cost as the scrap value that could be realized from the project. Okay. 4 things for all 3 projects. One is calculate the accounting rate of return based on the average investment method. Average investment method means you have to take average investment, that is initial injection, that is initial cost that you are putting, plus the scrap value divided by 2. So average of these two is your average investment in the project. Second is payback period, it is asking. Third, calculate the NPV using a discounting rate of 10. Fourth, the IRR. Okay. For IRR, obviously you have to take at 10, then again one more rate you have to take, suppose 20, and then interpolate and get the result. So if you are able to do this question, you will be covering the entire chapter. So we'll calculate one by one all the things that is being asked in the question. Okay. So be very attentive in this question. Maybe you will have some doubt. Then you stop me immediately. Okay. So I have just copied here everything that is given in the question. Okay. So how the project goes, year 0, 1, 2, 3, 4, 5. Okay. That is given in the question, 0, 1, 2, 3, 4, 5. $1,000 is the currency factor that we have taken. I have copied here. Then initial investment 125, 120, 170, 125. Neeti, just stop me wherever you feel confused or wherever you have doubt. Okay. Because
Okay, sir.
Yeah. But be very attentive with this example. Okay. So 125, 120, 170. Then cash flows 50, 50, 50, 50. So here 50, 50, 50. This is 75. I'll tell you why. Just for the timing, it is just park it. Then here it is 15, 15, 15, 15 and 200. 15, 15, 15, 15 and 224. We'll again park it here. Then here it is 120 and 80. So 120 and here it is coming 114 instead of 80. We'll just park it here. Here it is saying that you will be realizing at end of the year 20% of the initial cost, 20% of the initial cost as scrap value. So that should also be taken as a cash inflow at end year. So we'll just calculate the scrap value and add it to the last year. Okay. So we'll just calculate the scrap value that they are saying 20%. 20% of the initial investment. Here in project E, that is the first project E, the initial investment is 125. So 20% of it is 25. Similarly, here in project F, The initial investment is 120, 20% of it is 24. Here in project G, the initial investment is 170, the 20% of it is 34. So we'll just add it in the last year cash flow of these projects. So here it was initially 50 plus the scrap value. So 50 was in the question, this plus scrap value of 25, total coming to 75. Clear? Okay. Here again, last year it is 200 as given in the question, plus the scrap value, that is 24. So it is coming 224. Similarly, here it is 80, that is given in the question, 80 plus what is the scrap value, that is 20% of 170, 34, 80 plus 34, it is 140. Okay. Now they have asked, first we'll see the NPV. We'll go with the best thing that we do on a day-to-day basis, that is NPV 10%. So we'll just put the discounting factors, present value factors, that is for year 0, 1. Then for year 2, 3 and 4, we'll just see from here 0.909, 0.826, 0.751 and 683. So 0.909, 0.826, 751, 683 and last is 0.621. Okay, 909, 826, 751, 683, 621. We'll just put here all discounting factors and we'll just see the discounted cash flow. So for first year it is coming to 1, so it is multiplying with the 1 the cash outflow for project E. Project E, first year it is 0.909 into 50, second year 0.826 into 50, third year 0.751 into 50 and fourth year 75 into 0.683. So my NPV is coming to sum total of all these things, that is 50.53 is my NPV for project E. Now similarly, I'll just calculate the discounted cash flows for project F, that is just multiplying the present value factor into the cash flow of project F. We'll just multiply it and got to know that my NPV is coming to 66.64, that is just by adding the present value of inflows and present value of outflow, sum total of it. Similarly, if we go for project G, multiplying with the present value factor the cash flows year 1, year 2 and year 3 and sum totaling it coming to 33.24. Clear till now, Niti?
Yes, sir.
Okay. So we have completed this part, first thing. That is NPV, we are very much clear and we have calculated. Next is payback period. Okay, payback period, for that we require cumulative cash flow. So we'll just calculate cumulative cash flow. That is none other than initial, whatever is the net cash flow plus current year cash flow. So first is this, then just adding the cash flow and getting the net amount, then next year and last year. Similarly, we have done for F project also and G. So we could see for project E, the payback period would be somewhere between 2 and 3. Somewhere between second and third year, you will be getting your payback entirely. It would be second year plus whatever is left, that is 25, divided by the cash flow for the next year. That is this divided by the cash flow of the next year, 50. So we'll get the payback period for project E. If we want to see for project F, it would be 4 to 5 years. In between 4th and 5th year is the payback period. That is 4 years completed, and in 5, 60 divided by whatever is the cash flow for the next period, that is 224. And for project G, it is between first and the second year, that is first completed and second how much part, 50 divided by the cash flow for the next year, that is 114. Okay, so we'll just see the payback. EFG, that is 2 years complete. Complete year in any case will take, because in any case it is turning positive in the third year. Okay, it is turning positive in the third year. So 2 years completed. Similarly for project F, 4 years is completed, and in fifth year it is turning positive. So 4 to 5 is something where the payback is coming. So 4 years is the complete. For project G, it is coming 1 to second. So first year complete, second year some part. So first year is the complete. Then what is the amount left? We'll see for each project. Here it is 25 negative till we are turning into positive. Here it is 60, here it is 50. Okay. And what is the cash flow for the next year is for project E. It is 50. That is the cash flow for the third year when it is going to positive. Here for project F, it would be 224, and here for project G, it is 114. So 224, 114. The partial year percentage would be 25 divided by 50, 60 divided by 224, and 50 divided by 114. So payback period would be 2.5, 4.27, 1.44. If we want to convert into month, then 2 years and 6 months. That is 0.5 into 12. That is 1 year is having 12 months. So 2 years and 6 months. Here it would be 4 years and 4 months. 3.21 turning into 4. We have to turn into more months. So 3.21 is equal to 4. Then here it would be 1 year and 6 months. By this, payback period will be calculated for each of the project. Is it clear, Niti?
Yes, sir.
Okay. Now we have calculated this. Next is annual accounting rate of return. We know the formula of accounting rate of return, which is, okay. So accounting rate of return is equal to average annual cash flow. I'll just show you the formula, then we'll go into depth. Accounting rate of return is equal to average annual cash profit, not the cash flow, divided by average investment. Average investment means initial investment plus scrap value divided by 2. Okay. If I show you here, I'll just put this also. Initial investment plus scrap value divided by 2. Okay. So these things we have already covered at the beginning of the chapter. So we'll use it. We'll see. Okay. So scrap value we have already calculated. If we want to calculate the average investment, that is initial investment plus scrap value divided by 2. Okay. So what we are doing here is initial investment 125 plus scrap value 25, totaling to 150 divided by 2, that is coming to 75. Okay. Similarly for project F, it is 120 plus 24, that is scrap value, 144 divided by 2 coming to 72. Then here initial investment is 170 plus 34 totaling to 204 divided by 2 totaling to 102. Okay. We got the average investment for all three projects. Now what is required is average profit. So if we want to see the average annual cash flow, it is 50, 50, 50. Here also we'll take 50. We don't have to add the scrap value. So what I have taken is 50 plus 50 plus 50 plus, here since it is already added scrap value, I'll just deduct from here. Okay. Totaling to 200. Now average I want. So it is for 4 years. I'll just divide it by 4. This calculation is clear Niti? How I got average annual cash flow? We have to remove the scrap value. Is this clear?
Yes, sir.
Okay. Similarly, if we want to calculate here, it is 15 plus 15 plus 15 plus 15 plus 124 minus scrap value divided by how many years? 5. So here I have to divide by 5. Coming to 52. Okay. Here what I will do? 120 plus 114 minus 34 divided by 2. Only 2 years. That is coming to 100. I have calculated the average cash flow for all the investment proposal. That is E, F and G. Okay, correct. Now, this is cash flow. I need profit. Now you will say, sir, how to convert cash flow into profit? Very easy. Just remove the depreciation. So cash flow includes the non-cash expense, that is depreciation. For getting into profit, you have to deduct the depreciation. Depreciation in any case, we can calculate. Investment, how we can calculate depreciation, that also formula I'll write here for your easy access. Depreciation is equal to initial investment or initial cost, I would say, minus scrap value, okay, divided by life of the asset. Okay, this is the formula for depreciation. Now, how to calculate depreciation is simple. Initial investment we know for all the projects. Here it is 125. Scrap value is 25. So if we want to calculate depreciation, initial investment or initial cost is 125 minus 25, that is 100. Life of the asset is 1, 2, 3, 4, 4 years. So 100 divided by 4, it is 25. Okay. Similarly, if we go here, 120 is the initial cost minus scrap value 24, that is net 96. Life of the project is 5 years. So divided by 5, coming to 19.2. Similarly, if we go here, it is 170 minus 34, that is scrap value, coming to 136 divided by 2. 2 years is the life. So 136 divided by 2 is around 68. So we got the depreciation. Now we can calculate the net average cash flow, that is none other than average cash flow minus depreciation. For all we'll calculate. Okay. Now all my inputs are ready. We'll just calculate the accounting rate of return, that is none other than the net average annual cash flow divided by average investment for each of the project. Okay. Clear till now, Niti?
Yes, sir.
Okay. So we have completed this part, and this. I will just show you how to calculate for one project the IRR. Anyways, the method will be same. The two projects you can calculate on your own as a homework. If there is an issue, we can discuss at the starting of the next class. So we are already having the NPVs at 10% discounting rate. Next, we have to take one more discounting rate so that we can get NPV at two rates. One should be lower, second should be higher. So suppose I am taking 20%. Any rate you can choose more than 10. I am taking 20 so that I can get a positive and a negative NPV if possible. Will not go again and again. Sir, at 20 I got again positive. Shall I again do NPV for 25? My answer would be no. Just take the maximum gap. If negative coming, it is okay. If not, then you go ahead. So I have taken 20, suppose. So with 20, what answers I am getting? 20, I'll take it. Okay. Again, cash flows would be same. That is 125, 50, 50 and 75. Just copied from up. Same for this project and this project. Okay. Now the discounting factors I have taken for 20% instead of 10. So 20, what it is coming? 833,694,579. 833,694,578 or 79, just rounding up. And 482,402. 482,402. Okay. Then discounted cash flows, just multiplying discounting factor with the cash flow. Same for F and G. Okay. If I'll sum up, I'll get the NPV. So here, see, I am getting all the positive NPV. Now I will not go for again, sir, no, I will calculate for 25. No, I got to NPV. If it is coming positive, negative, then it is best. If not, then also we'll go ahead. Okay. For project E, suppose I am calculating. In any case, my formula is lower rate plus NPV at lower rate divided by the difference of NPV, that is NPV lower rate minus NPV higher rate into the difference of rate. Okay. So here it is 10%, that is lower rate, plus NPV at lower rate, which is 50.53 divided by 50.53 divided by NPV at lower rate, that is 50.53 minus NPV at higher rate, that is 16.44 into difference of rate, that is 10. So when we'll multiply this with this, we'll get 14.82 plus lower rate totaling to 24.82 as my IRR. Okay, same way we can do for all these F and G. Coming to 21.5 to 23.77. This question is very important as you will revise all the concepts. Please cover all the concepts that we have covered, all the 3 chapters that we have covered, NPV, IRR, everything. It is very important. It is a building block. So don't just pile up that will cover later on and all, because when I'll be moving to next chapter, everything will be linked to NPV IRR. So if you don't know how to calculate NPV IRR, then you won't be able to just find the decision making or find the concepts understandable to you. So just try to cover it up, stretch a bit and get a comfort with NPV IRR. Okay.